Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sise, your tutor and your mentor. Today, we are going to continue IFRS 9 financial instruments. I have already covered the key concepts of financial instruments that has to do with the financial liability as well as the financial assets. I've covered the classification and what you should look out for a transaction to be a financial instrument. For a transaction to be a financial instrument, there must be a financial asset of one entity and a financial liability of another entity. So basically, that's the definition of financial instruments. I've also covered the key concepts of financial assets. So basically, today we are going to look at the difficult aspects of IFRS 9, which is the financial liability. So basically, when we are talking about financial liability, in simple terms, it is an obligation to settle a transaction in the future. Looking at the definition of liability from the conceptual framework is the same. Forget about the language of financial. Don't worry about that. So now we are going to look at the initial recognition and the subsequent recognition. So now when we are talking about the initial recognition, it means how are we going to recognize the financial liability at the inception date? Now, for example, on 1st January 20x6, I took out a loan from X, Y, and Z bank, for example, right? In my books, I'm going to debit my cash, my bank, then I'm going to credit my financial liability because at the end of the period, I'm going to repay back the loan. On annual basis, I have to pay interest on the loan. I have to pay cash payments as a result of the loan. So impliedly, I have a present obligation to settle transaction in the future. So that's a liability. So I'm going to debit the bank because I'm going to receive the money, then I'm going to credit the liability. That's the initial recognition. But now the key concepts about the initial recognition, a financial liability is initially recognized at its fair value. When you're going to look at IFRS 13 fair value measurement, you're going to understand the concept of fair value. But for now, let's keep it simple. This is usually the net proceeds, very important concept. The net proceeds, this is usually the net proceeds of the cash received less any cost of issuance. Now, for example, the loan I mentioned few minutes ago, the loan amount is $10,000, for example. I'm going to debit bank with $10,000. I'm going to credit liability with $10,000. Now, if there is any issuance cost, for example, insurance costs relating to the liability, legal fee, any other cost that directly link with the facilitation of the loan, I'm going to deduct it from the proceeds. Then if there is any discount, for example, if the loan is issued at discount, then I'm going to account for the discount as well. So, the net proceeds less any cost of issuing the liability. The difference, the outstanding amount, is what we are going to debit as bank and what we are going to credit as liability. Very important concept. So for the net proceeds, for the liability will equals to the net proceeds or the proceeds. Let's put it before the net, the net, the proceeds minus discount on issuance minus cost of issuing. So this will give us the amount that we are going to debit as bank and the amount we are going to credit as liability. So basically, the double entry for the initial recognition journal, we're going to debit bank and credit liability. Very important. So now This is the first phase that you need to know. So at the contract inception, on the 1st of January 2086, I'm going to debit bank and I'm going to credit liability. So now, after I have credited the liability, on annual basis, what I am going to do to the liability, this is what we are going to look at, the subsequent measurement. When we are talking about subsequent measurement, it means after we have measured the liability using the initial recognition, how are we going to continue the recognition of the liability, of the finance cost, of the interest payment? Very important concept we need to know for the examination. The financial liability will carry that amortized cost. Now we are going to look at the amortized cost table to calculate the closing liability, the finance cost, and the interest payment. Other than liability for trading and derivatives, that are liabilities, both of which are unlikely to be seen in the financial reporting examination. Don't worry about it. So now what we should focus on here is how we can calculate the finance cost using the effective interest rate and how we can calculate interest paid, the actual cash payment. Very important concept. Now, let's understand a few things before I'm going to explain in detail. The effective interest rate will be different to the interest paid if there are additional costs of borrowing, such as the redemption premium, issue cost, or the discount on issue. Now, very important concept. On normal ground, the effective interest rate and the interest paid will be the same. If the effective interest rate and the interest paid is not the same, this will be as a result of either the loan will be redeemed at a premium, or the issue cost, or the discount on issue. So these three factors can give a significant cause for the effective interest rate and the interest paid not to be the same. So very important. So when there's a distinction between the effective interest rate and that of the interest paid, then it means either there is a premium, either there's or redemption, or either there is an issuance cost, or whether there is a discount on issue. So very important concept that you need to know. So now let's understand the concept of the effective interest rate. The initial value is the initial recognition amount. Let's understand. Initial value is equals to the initial recognition equals to the initial recognition amount. Simple. Now, the effective interest, which is the same as the finance cost. Now, what do I mean by finance cost? Now, on annual basis, we are going to debit expenses. Finance cost, we are going to debit expenses, the P&L, and we are going to credit the liability. We are going to increase the liability on annual basis. Why are we going to increase the liability? Because at the end of the period, we are going to pay the increased liability. We are going to pay the closing liability for that period. So basically, for the finance cost, we are going to debit expenses and we are going to credit liability. And the finance cost, is calculated on the closing liability for each year. Now, the closing liability for year one will be the opening liability for year two, and so on. So basically, when we are going to calculate the liability for year two, we are going to use the closing liability for year one to calculate the finance cost for year two. So this is what we are going to do. We are going to debit expenses and we are going to credit liability. Credit liability means we are going to increase the liability. That's why from the formula here, you can see we add the finance cost, the effective interest rate. So we can calculate the finance cost using the effective interest rate, not the interest paid. Note, finance cost is calculated using the effective interest rate. Very important concept. Why are we going to use the effective interest rate? It might be within the component of the question, the effective interest rates will take into consideration the impact of the issuance cost, the impact of the redeemable at premium, or the impact of issue the loan at a discount. Either of the factors will be considered in the effective interest rate. So that's why we are going to use the effective interest rate to calculate the finance cost that we are going to recognize as an expenses on annual basis, and that we are going to use to increase our liability. If it is the same, it's fine. If it is different, we need to account for it differently. So now, so now point three. Three. So we are going to look at the interest paid. So now, what is interest paid? It means on annual basis, on annual basis, we are going to pay the cash payment. Interest paid is the is the is the same as cash payment. So now on annual basis, we are going to make a cash payment of the interest rate. This is the actual payment, actual cash that we are going to pay to the bank as a result of the loan. So it will be the cash payment. So now this actual cash payment will be calculated using the interest rate, which is not the effective interest rate. Also, key concept to know, the the cash payment will be calculated using the nominal value. Using what? The nominal value. This is what we are going to use to calculate our interest paid. We are going to use the nominal value to calculate our interest paid. So basically, this is the concept that you need to know. You need to take note of these 3 points because they are very much important. Now, the double entry for the finance cost, the double entry or the journal, the double entry will equals to, we are going to debit the liability because we are going to reduce the liability, and we are going to credit bank because we are going to make a cash payment. Simple. So this is the concept that you need to know for how you can, recognize and how you can account for financial liability. The initial value, the initial recognition, we are going to debit bank and we are going to credit the liability. For the effective interest rate, which is the finance cost, we are going to debit expenses, we are going to increase the liability. For the interest paid, the actual cash payment, we are going to calculate it on the nominal value and we are going to debit the liability to reduce the liability, and we are going to credit the bank. Why are we going to debit the liability? Because we are going to reduce on the total liability that we're supposed to pay for each year, because that's why we are going to make a cash payment. So basically, this is the concept that you need to understand. Now let's look at illustration. Two, an entity issue a loan note for $1,000. The loan note is redeemable after 5 years, at a premium of 250. So now we are going to look at the concept of premium and the concept of issue at par, right? The interest rate, the interest of 5.9% is paid at each year end. So now, when we are going to calculate the interest paid, the cash payment will be, we are going to use 5.9% multiplied by the nominal value of 1,000. Why is the effective interest rate? We are going to use it to calculate the finance cost. So basically, this will be the concept. So now we are going to talk about the redeemable at premium. Very important concept. If a loan note is redeemable at a premium, it means at the end of the loan agreement period, we are going to pay extra amount in addition to the nominal value. So now if the nominal value is $1,000, then we are going to pay premium. It means at the end of the useful life of the loan, at the end of the life of the liability, we are going to pay $1,000 plus 250 the premium, plus any cash payment that we are going to make for that particular year. So these three components will contain within the final year of the liability. So we need to note down the premium means we are going to pay excess, we are going to pay extra amount at the end of the period. That's what we are going to do. So basically, look at the analysis down there. So now I'm going to explain the amortized table. This is the amortized table. The amortized table, it contains the year, it contains the beginning, the balance at the opening balance, the initial value. It contains the finance cost, which will be calculated percentage of the opening value. I've already mentioned that. Then the interest paid will be calculated on the nominal value, which is the 5.9% times the 1,000. So the difference between the opening balance plus the finance cost minus the actual interest paid will give us the closing balance. So the closing balance will be the opening balance. So we are going to calculate the finance cost on the closing balance, which will be the opening balance for year two. So year two finance cost will be calculated based on 1041 multiplied by the 10%. Then therefore the 59 will be the same because we are going to apply the 5.9% on the nominal value, not on the closing or the opening liability. Very important concept and distinction that you need to know. I'm repeat it again. The cash payment will be calculated on the interest on the nominal value, not on the closing or opening liability. So basically, at the end, which is year five, we are going to pay the nominal value and we are going to pay the premium of 250 plus the interest. So at the end of year five, there will be no liability. Instead, we are going to debit liability and we are going to credit bank. That's the final accounting treatment that we are going to do to de-recognize, to remove the liability from our financial statement. Now, when we are going to look at the next example, we are going to, to understand better. So for now, what you need to know is how you can the double entry for the finance cost as well as the interest paid. For the finance cost, we are going to debit the expenses and we are going to credit the liability. We are going to increase the liability over time. Why is the cash payment will reduce the liability and it will reduce our bank balance? Very simple. The amount carried forward at each year end represent the amortized cost value to be shown in the statement of financial position. So these values for year one, the closing liability will be 1041. For year two, 1086. For year three, this for year four, 1190. For year five, there will be no closing liability because that's the final period of the loan agreement. Instead, we are going to de-recognize that particular liability because the obligation has come to an end. So we need to de-recognize the liability. So now let's solve example one so you can able to start having a feeling and a taste of the question. So now example one, solution. What amount will be shown in the statement of profit or loss and the statement of financial position over the period of the loan? So statement of profit or loss, we are going to look at the finance cost, and the statement of profit or loss, we are going to look at the closing liability using the amortized cost model, right? So now it's very simple. Let's try to determine our value. So it means our initial value based on this question On 1st January 2023, an entity issue 5% loan notes at a nominal value of $20,000 with an effective interest rate of 5%. So from this question, the effective interest rate and the interest paid are the same. So it means there is no um, premium, there is no issuing cost, and there is no discount on issuing. The loan notes are repayable at par, which is at nominal, on 31st December 2026. From 1st January 20x3, 20x4, 5, and 6. So it means 4 years. 3, 4, 5, and 6. 4 years period. What amount will be recorded as a financial liability when the loan notes are issued? So now the initial value is equals to 20,000, which we are going to debit bank and credit liability. Very simple. That's what we are going to do. But now for the interest payment, the finance cost, you are going to calculate it at 5% on the closing liability, or it can be the opening liability, because the closing liability for year one will be the opening liability for year two. Will be on the opening liability or closing liability. Therefore, the cash payment, the interest paid, which is the cash payment, will will be at 5% for this question back, at 5% on the nominal value. So this is what you need to do. So now we are going to look at the amortized cost table. Amortized cost table. We are going to look at the year. We are going to look at the initial value or opening value. We are going to look at the finance cost at 5%. We are going to look at the interest paid at 5%, and we are going to look at the closing liability. Year one, the initial value is 20,000. The finance cost will be 5% of 20,000 multiplied by 0.05, which is 1,000. Then the interest paid will be 1,000 as well, based on this question. So therefore, the closing liability will be 20,000. So for year two will be the same, 20, 1,000, 1,000. 20,000 again. For year three will be the same, based on this question. But for year three, we are not going to get any, closing liability, because we are going to offset the whole interest. We are going to offset the whole loan at year three, because it's 3-year period. Right? So we are going to make full payment. Nothing to worry about. So at year three, we are going to debit the liability and we are going to credit bank. So this is what we are going to do. Very simple. Nothing to worry about. Any question? So now, this is the concept that you need to know. This is what we are going to take to the statement of financial position. So the finance cost, P&L, the closing liability, statement of financial position. Simple. So nothing to worry about. Let's go to example 2, so we can able to identify the distinction, right? For example 2, Same requirement on 1st January 2021, an entity issues 0% loan note at a nominal value, 0% loan note. So the initial value, which is 40%, the nominal value for 40,000, and the loan notes are repayable at premium. At premium, very important, on 31st December 2023, 1, 2, and 3. So in 3 years' time, the loan note will be repayable in at a premium. So now what we need to know, if you look at the interest paid, the rate is 0%, whilst the effective rate is 9%. Why? There's a distinction between the interest rate and the effective interest rate because of the premium. Because of the premium, the effective interest rate is 9%, very huge percentage. Whilst the cash payment, the interest paid is 0%. So now we are going to account for it so we can able to identify the difference clearly. So now the finance cost at 0%. So on annual basis, we are not going to make any cash payment to our loan provider. We are not going to make any cash payment. But at the end of the loan period, we are going to pay a premium in addition to the 40,000 of 11,800. So now, the the interest paid, the interest paid, and the finance cost, the interest paid, the finance cost at 9%. So now, redemption value is 11,800 at year 3. So now we are going to use the amortized cost table. Here, opening liability, finance cost at 9%, interest paid at 0%, closing liability. Year 1, 40,000. The finance cost is 9%, 0.09 times 40 will give us 3,600. The interest paid is 0. The closing liability will be 40 plus 3,600 will give us 43,600. Year 2, the opening balance will be year 2, 43,600 multiplied by 0.09, which will give us 39,24. Cash payment will be 0 plus 29,34 plus 43,600 will give us 47,524. Year 3, 47,524. The finance cost multiplied by 0.09 will give us 4,277, then minus 0. Then this will give us plus 4,7,524 will give us, it's supposed to be a closing liability of 5,1,801. But at the end of the period, there will be no liability. That's why we are not going to include this. There will be no liability. What we are going to do, we are going to debit the liability and we are going to credit the cash or bank. So now, at the end of the loan period, which is 31st December 20x3, I think, yes, 20x3. So now what we are going to do, we are going to debit the liability and we are going to credit bank. So now what amount we are going to use? We are going to use the nominal value and the premium. That's why in normal sense, the closing liability should equals to the redemption value plus the nominal value. So now we are going to credit bank with the par value plus the redemption value, which will equals to $40,000 plus 11,800. So this will give us 51,800. Now the liability also by the close of the period is 51,800. 51,800. So basically the liability, we are going to debit this liability. So at the end of the period, there will be zero for the liability. We don't have any liability. Whilst we are going to credit cash or bank. So basically, this is the accounting treatment. For the finance cost, we are going to treat as expenses. There will be no cash payment for this question. Then for year one, there's a liability of 43,600. For year two, there's a liability of 47,524, which will be shown in the statement of financial position. Then at the end of the year three, we are going to debit a liability to offset, to de-recognize the liability, and we are going to credit the bank using the par value plus the redemption because the loan liability will be redeemed at a premium. Very important concept. So now we are going to look at example 3. Example 3, a solution. Same requirement. On 1st January 2022, an entity issue 4% loan note with a nominal value of this. So the nominal value is equals to $20,000, right? On the loan notes are issued at a discount. You can remember at initial recognition, when we are going to recognize the liability using the initial measurement, we need to account for any discount as well as any issuance costs that they are given in this question. So for us to calculate our initial value, we are going to our initial liability, initial value, we are going to use the nominal value, we are going to less discount at 2.5% of the nominal value of the cash that we are going to receive, and we are going to less issue cost. So basically, um, so this will equals to 2.5% multiplied by 20 will give us 500. So we are going to less this 500, and also we are going to less the issuing cost of 534 minus 534. So the difference will be 20 minus 500 minus 534 will be 18,996. That will be the initial value that we are going to use to recognize the liability. So its initial value will be 18,966. So now for this initial value, we are going to debit bank, use 18,966, and we are going to credit liability equals to 18,966. Very simple. This is what we are going to do for initial recognition. Now we are going to look at the subsequent using the amortized cost. The amortized cost table. Here, opening liability or initial value, finance cost, at what percentage given in the question, the effective interest rate is 7%, interest paid At what percentage? 4% given the question. And the closing liability. Closing liability. Pam. How many periods? Um, on 1st January to 31st December, January 20th to 31st December 20x6, 20x2, 3, 4, 5, 6. So 5 years. We are going to do this for 5 years. So year one, the opening liability will be 8996 or 8966, sorry. And then the finance cost will be 7% of 18966 multiplied by 0.07 is 1320 to the nearest degree 28. And the finance cost will be 4% off 4% of the nominal value. So 0.04 multiplied by 20 of the nominal value. Don't forget, don't forget, don't forget 18966 plus 1328 minus 800. So this will give us 19494. Very important concept and very important thing for you to note. I'm going to repeat it again. The interest payment, the cash that we are going to pay, the cash that we are going to pay will be on the nominal value. Will be what? On the nominal value. So we are going to do this for year two as well. We are going to do it for year two. Oh, so we are going to do it for year two. 19494. We are going to take 7% of it. 19494 multiplied by 0.07 will give us 1365 to the nearest degree minus 800 as well. So therefore 19494 plus 1365 minus 800 will give us 20059. So going to do it for year 3, 20059 multiplied by 0.07, 1404 minus 800, 20059 plus 1404 minus 800 will give us 20663. Here 4, 20663 multiplied by 0.07, 7% will give us 1446 minus 800. 20663 plus 1446 minus 800 will give us 21309. Here 5, 21309 multiplied by 0.07, 1492 minus 800. 21309 plus 1492 minus 800. 1492 minus 800 will give us 22001. Here 6, which is the final period. 22001 multiplied by 0.07, which is 1540 minus 800. Now, when we are going to minus the 800, we need to look at the question. If there is a premium, we need to account for it. Premium of 10%. So 10% will be calculated for premium. So 10% of the nominal value will give us a premium. So now the premium value will equals to 10% multiplied by the nominal value of 20,000, which will give us 2,000. So now 22001 plus 1540 minus 800 will give us 220741. So at the redemption date, this is what we are going to do. We are going to make a premium of this. And the liability, we are not going to account for it. There is a rounding difference from this particular question. Right? So now let's go again the requirement. What amount will be shown in the statement of profit or loss at 31st? Oh, the question is for 31st December 20x2. Sorry about it, but never mind. We have gone through it, but the requirement is for 31st December 20x2, which is for this period. So this will be the liability, this will be the expenses that we are going to show, the expense amount of 1365 in the statement of profit or loss, and this we are going to show it as liability in the statement of financial position. So basically, this is the concept that you need to know. But if you want to solve this to the end of year 6, this is how we are going to solve it. At the end of year 6, which is this period, we are going to derecognize the liability. This closing liability, we are going to debit the liability and we are going to credit cash at bank. So basically, the nominal value, which is 20. So basically, it's something like 22,000 in simple 22,000. So now, what you need to take home is how you can calculate your finance cost and which rate you are going to use to calculate your finance cost and which amount you are going to multiply to determine the finance cost. For the interest paid, you need to know which you are going to use to calculate the interest paid. You need to know on which amount you are going to multiply to calculate the interest paid. Then in a situation where the premium value is given to you, percentage, you need to know how you can calculate the percentage. Very important. So now let me do it in a simple term. This is the cost. The redemption cost is 20 plus what else? The premium, 2,000. Then we are going to pay the cash payment in simple term. So this is what we are going to subtract. So nothing to worry about. So this is the account statement, and this is all what we are going to cover for today for the financial liability. So you need to look at it technically because the later session we are going to look at more complex area. We are going to look at the compound financial instrument that has the future of both debt and equity. So how we can split between the debt and how we can split between the equity. Also, we are going to look at the preference shares, how we can account for preference shares, how we can account for ordinary shares, whether it's a loan, whether it's not, we're going to look at it. And also we're going to look at interest and dividend, how we can account for it as well. Then we are going to look at the compound financial instrument. So for this session so far, we are going to stop here. Don't forget the takeaway point, the calculation of the finance cost, how you can calculate it, which rate should be used, and why are you going to use the rate, and why there is a distinction between the effective interest rate and the interest rates paid. You need to identify this distinction because in most objective test questions, these are the areas where the examiner will manipulate so you can not able to get the correct answer. So thank you very much for your time.